It is once again time to turn our attention over to the grain markets. This week, we're looking back at a recent conversation we had with the president of Global Commodity Analytics, that is Mike Zuzolo. We get his take on the commodity markets for the production year 2024. We're going to talk about prices, crop prices, where they sit today for corn and soybeans in particular, and kind of your outlook as we go throughout the next several months in 2024. What are the biggest factors driving the markets as we speak?
Well, the biggest factors are that we're going to have a lot of big factors in 2024, and it's going to be, if we thought 2023 was volatile and kind of put your bootstraps on, 2024 is going to be even more so. And I say that because about half the world is going to vote in an election this year, not just the United States. And the geopolitical situation, the economic situation between what's going on in the Middle East and Asia versus how well we're doing here in the United States, that's attracted a lot of attention in the form of a stronger currency here in this country. The other thing I think that makes this year probably more volatile than normal, Bryce, is just the fact that the market, it's almost the exact opposite of 2023. In January, we were talking about 2012 drought. We were talking about how high prices could go. And we were talking about how would we be able to sell and not worry about it going sharply higher. This time of the year, a year later, we're in the exact opposite mindset, especially when it comes to corn and wheat. The market is so negative, in my opinion, and I think that's where we've gone from one extreme to the other, and I think that's going to create extra volatility. A perfect example is what we're going to be talking about at some of the winter outlook meetings, is the fact that at this point in time, the managed money positions in corn are the biggest since June of 2020, to the downside, the biggest net short position since June of 2020. The trade is very nervous about China's deflation and having a situation develop like that, and that takes commodity prices down even lower in 2024. And so we've already started to kind of begin to build that in. The history would suggest, though, that the funds get short, and then the funds come in and at least flatten out and maybe even get long, depending on their supply-demand fundamentals and weather.
I want to have you break down what you mean by that exactly for our viewers today. When you say the funds are short, what's that mean in particular for corn here?
Yeah, this is a good question because there are different types of funds out there. There's different types of alternative investment. Well, what I'm really focusing on in my research this year, and I have what I've had for a long time at what's called value levels, a good place to sell, I think, and a good place to buy in the major agriculture commodities. For example, right now, we're at roughly 12.05 as we head into the middle part of January for November beans. That's actually my overvalue level for November beans. And so I'm very eager to start selling 2024 beans if the corn and wheat don't come in and support the soybeans. And so the managed money funds that I focus on are the ones that are reported by the CFTC on the commitment to traders data, because we have to have something that's trackable. And I think that's what's really key. And there's a very strong relationship between the price of corn futures and the managed money fund position. It's not one-to-one, and sometimes it deviates, but it's a pretty strong relationship between the two. And so managed money funds tend to drive the commodity markets, in my opinion.
Doesn't sound like you're super bullish on your long-term outlook here in 2024. What could make you more bullish, though?
The biggest thing, and I'll go back to what we just talked about, is China and this negative demand perception, this deflationary perception. They clearly have a property bubble that has burst. They clearly have a consumer that is getting hammered by both property investment and stock market investment. And with them being such the big player in the commodity markets, just from a standpoint of not only what they import, but also what they export, and what they do with the rest of Asia in terms of driving their economies, I would say you've got an issue where if they can come back around in a strong way, I think the funds and the traders may start to look more brightly upon the demand side, and that's exactly what I'm looking for as we head into March.
All right, we'll keep an eye on that. Mike, I want to get your thoughts on creating a marketing plan. Sometimes the winter months are a good time to reflect. A lot of people hauling grain right now, perhaps for the price that they're not extremely happy with. How can you use this time to be thinking about the 2024 crop, and where do you even begin?
I think you begin with the idea that, are you going to switch any acres once we know the February base price on the crop insurance side of the equation? That is such a massive player in terms of how the futures market trades and also what's happening on the farm. So I think, Bryce, that's probably the first place that I would start if I sat down with a brand new client and saying, how much would you change and swap out acres and move rotation based upon price? And if that's not very much, I think then you start thinking about your profitability, and you start with what's profitable in the last few years. Early in the year, maybe with the exception of 1 or 2 months, it's been soybeans. And so like 2023, that's part of the reason why I really am not hesitating to hedge beans, because the profitability at 12 is still there for the producer, break-evens that I've seen so far. Corn, you just can't get from here to there at this point, and so you wait, and you wait for the market to change its dynamic. But I would also say that if the beans go sharply lower, and you're worried about that, but you don't want to sell cash, I have found that the last few years, because of the fund investment, amplifying and exaggerating market moves, it might not be a bad idea, and I have to say this on a one-to-one basis, to look at maybe putting a floor underneath you with a short-term put option, so that if you do have a 50 or 60 cent drop in soybeans, you're not sitting there watching it and not being able to participate in that drop. So I think that's one of the things that I really want to encourage producers to think about, because I think it's good risk management, and I think the risk-reward ratio from a standpoint of making better decisions and not feeling trapped is there.
Okay, I want to end with this. Get your thoughts on this question. What's something in the markets or something at play here in the next few months that isn't being talked about enough right now?
I think the biggest thing, based upon my research, is probably the issue with the mechanization of the markets, and how, in the big picture, Bryce, if we don't find a way to get producers more opportunities to hedge, I think food crises are something that is out there looming, because I think the market does not scrutinize data as much as it should. In terms of those computer-driven models, just take the data and assume it's correct. And I think the Brazilian corn crop is a perfect example right now. We think it's an average to above average crop still, because of the USDA data and because of the trade not really scrutinizing that data, even though there's tons of private estimates out there that would say it's not a good crop, or not nearly as big as we thought it would be. So I think that's probably the biggest, I guess if I had to use the word fear, in my line of work, having started this in 1995, I feel like the mechanization of the commodities, the financialization of the commodities, could, if we're not careful, lead to some type of food crisis, because we're not rewarding those producers for what they're putting out there each and every year.